Let's get started, you guys. I hope you're sitting up straight in your seat. You're on the edge of your seat, phones off, notes out, computers open, follow along, take notes. If you have questions, write them down. I don't know that I want to answer everyone as they come, but maybe towards the end. So if you have a question, keep that in mind, and we'll do our best to get that answered. I got a lot of content and materials that I want to dive in with you guys today. As I'm trying to navigate the space of time that we have, I really want to maximize the utility of this time. So I'm really hoping that we can build a lot of value and help you guys see leaps and strides in your own trading. Quick question for you guys. Who in here has been trading for, say, less than a month? Raise them big. I'm just really curious. Less than a month. Okay. Less than 6 months. Less than 6 months. More than 6 months. Okay, so it looks like we're like in the 6 month and under, most of you guys. So most of you in here, you've already began to experience and taste, let's say, a lot of different styles. You've been able to attend many webinars and in your own demo accounts experience a lot of different things, okay? My own trading has evolved in such a way that I'm very much a long-term trader. And there's many reasons why that's the case. And I really want to help exemplify today why that's the case for you. Build a case for this, okay? It's good to be well-rounded, and it's good to understand the different tools at your disposal and how to, Brady did a fantastic job discussing ways of scalping. Troy, more mid-range, different style there, and the long-term style that I'm going to be talking to you guys today. I want to build a case for you to see and outline this because it really requires a different mindset. You're going to be able to look at this and say, oh yeah, that makes perfect sense logically. But when you integrate money and emotions into the ingredients, it can be a lot different when you're sitting in front of the computer and you got real money in the markets and there's real risk involved, okay? So what I want to do is help give you tools, help give you principles that are going to help you navigate that space as you really embark on your own, say, sandbox of long-term trading. So to get things started today, everyone in here, I'm sure, knows who Tony Robbins is, right? One thing that he pushes constantly in his trainings is this idea that if you want to be successful, find someone who has achieved the results that you want to achieve and model what they do. Okay? Don't try to reinvent the wheel. Okay? When it comes to trading, that can be a really easy thing to do, to reinvent the wheel, to try to do something on your own and try to reinvent something, okay? Did you know that you can always tell who the pioneers are because they have arrows in their back and they're lying face down in the dirt? Okay? Who's tried to be a pioneer in their trading in any way? I'm going to try this. I'm going to try that. I'm going to try this. I'm going to try that. You go down these rabbit holes of different things, right? And it's good to experiment, but the point I'm trying to make here is rather than go it alone in this very competitive marketplace we call the financial markets, where you're up against the most well-capitalized institutions and entities in the world, why don't we go out, do some homework and due diligence, and as Tony Robbins is suggesting, model those who have been successful. Would you guys agree with that? Don't try to reinvent the wheel, model those who have already achieved success. Well, who are some people that have achieved success in the trading world? And we're not talking just a little bit of success, guys. We're talking bona fide, really remarkable results. Warren Buffett's one, absolutely. Can you guys think of any others?
Matt Watts.
Oh, gosh, guys. Yeah. I won't tell you how much I paid him to say that. So how have the world's most successful traders done it? That's a worthy question to do some discovery. Well, let's take a look at some of them. We've got gentlemen like Ed Secoda, Richard Dennis, Paul Tudor Jones, David Harding, Martin Schwartz, Jesse Livermore. These are guys, ordinary people, just like you, just like me, that embarked in the financial markets and made hundreds of millions of dollars. In fact, there's a few on this list that made billions with a B of dollars in the financial markets. Well, good gracious. Are they just privy to some secret hidden knowledge then? Is that what it is? Do they know something that we don't, that's just underground? Maybe they're lucky. Maybe they just got lucky. There's some of the few that struck it rich randomly. Or are they just natural-born prodigies? They're born with it, and that's why nobody else really stands a chance. Okay, these are questions worth asking. Here's what I found in my studies. There's one core common denominator amongst all of these greats. And you guys, those were just a few that I listed and some that I've really studied. Okay. Aha moment commencing underway here. Okay. All of these guys, all of these great legendary traders, we could stack them up side by side. And what you're going to find is that no two of them are the exact same in their trading. They have unique styles. They have differing opinions about the markets. They have different uses of indicators, right? They have different strategies that they employ. Different indicators, different entry and exit rules. They may differ on the way they use the fundamentals versus technicals in the market. Different strategies and even different risk management strategies, okay? But there's one core common thread, powerful principle that they all share, and it unites the whole of all of their trading. And I want you guys to think about it, what that might be, okay? What might that be? William Eckert, here's another one that was a legendary trader. And in his experience, what he is saying, what he's claiming as the two cardinal sins of trading, the two things that you can't break. If you want to be successful, you can't do it. Giving losses too much rope, taking profits prematurely. Okay. Out of all the things he could have cited, those two. These are attempts to make current positions more likely to succeed to the severe detriment of long-term performance. There's a lot of good stuff packed into that statement right there. Here's some more wisdom from the greats, okay? So Victor Sperandeo, he said, the key to trading success is emotional discipline. If intelligence were the key, there would be a lot more people making money trading. Would it not be true? If all it required was intelligence, there'd be way more people making money. Or if all it took was technology. We're in the greatest technological time in the world, right? It doesn't mean trading is necessarily better. So here's what he says. I know this will sound like a cliche, but the single most important reason. Okay, here's a guy with decades of experience, and out of everything he could cite, he's saying this one thing, you guys, one thing. The most important reason that people lose money in the financial markets is that they don't cut their losses short. I want you to sit in that space for a second. Is he saying anything about they don't have the right strategy? They don't have a big enough winning rate? They don't follow this certain thing, XYZ? No. He's claiming that it's because they don't cut their losses short. All right, Ed Secoda. Ed Secoda is one of these unique legendary traders in that he was one of the few that actually made billions. Okay, it might be worth listening to him, what he has to say. If you can't take a small loss, sooner or later you will take the mother of all losses. Okay, so for those of you that want to be candid and open, how often have you placed your trades and things tend to be going pretty well? And over time, you tend to increase your stop loss, and increase it a little bit further, or you get into a trade and you hold on to it. It's going to come back. It's got to come back. It's done it before. And then you take the it's done it before and extrapolate that to it's going to do it every time. And then you hit the mother of all losses. Anyone experienced that? I'll raise my hand. Wow. Wow. None of you? Okay. Oh, there. Okay. Don't be shy. What's that? There's a little bit of greed there, isn't it? Or hopium in there as well. Okay. Another one by Ed Sakota. The elements of good trading are, number 1, cutting your losses. Number 2, cutting losses. And 3, cutting your losses. If you can follow these 3 rules, you might have a chance. Right? So if we invert that statement where he's saying you may have a chance, in other words, if you do not do those things, which he's repeating again and again, if you don't do it, then you don't stand a chance. You will not stand a chance. And George Soros, very, very famous Forex investor, another multi-billionaire from the markets, it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. And I want to unpack this statement for just a moment. That first piece, it's not whether you're right or wrong that's important. You guys, what's the measurement of whether you're right or wrong in trading? What measures that? Win rate. How much you win and how much you lose is measured by your win rate, right? What's he saying? It's not whether you're right or wrong that's important. It's not about that. What it is about is when you are right, how much you make, and when you are wrong, how much you lose. That's what's more critical here. So what is the core this is what, in my opinion, I consider the core doctrine of trading. And when you violate it, you're going to find things being more difficult. And when you do abide by it, it's going to be a lot more refreshing and lucrative for you. And what is that core doctrine? All of these guys practiced it, they preached it, they believed it, despite them being different one from the other. Anybody?
Winners run.
Manage risk.
What was it over here?
Let your winners run.
Let your winners run. What else? Cut your losers short and let your winners run. It's fascinating. You study these guys as different data points, one from the other, and despite all their differences, there's this common thread that weaves in and out. So what was it that Robin said, right? What's that approach I started with? Model those who have done this successfully. Don't be a pioneer. You're going to have arrows in your back, face down in the dirt. But isn't it ironic, you guys? Isn't it ironic? I found myself in this space, at least, okay? So I can speak for myself. That, and I see it a lot with students I work with, is that the inversion of that core doctrine. We cut our winners short, super fast, 3 pips, close it. Close it, close that money, get it in the bank that money, 5 pips. Oh, that loser. Yeah, we'll just let it rest for a little bit. Check it tomorrow. Let it go for the week. You know, it's this utter inversion of that doctrine of cutting your losers short and letting your winners run. We tend to do the exact opposite, isn't it? So then you're trading along and along and along, and you're building up your trading account. And then due to one bad trade, who's experienced this, you guys? I hope we have people comfortable enough just to be honest and share, because I'd venture that most everyone in here has experienced this. You've built an account that you've put a lot of energy and effort into, week after week after week. And you see that equity curve growing and building and growing and building. And then, seemingly in a moment, cliff, drops like a rock. Maybe just because of one bad trade, maybe two bad trades. And all that hard work just got unraveled. You push the ball up the hill and it's just back down. Anyone experience anything like that? Okay, there we go. Now we got some honest people in the room. Okay.
I'm hoping that you'll get into this because I've had this happen to me several times. I'll take a trade, set a stop loss. The stop loss gets hit, it continues to go the wrong way for a little bit, and it comes back down and eventually would have hit my take profit. I've had that happen several times. I've also had situations where I've set stop losses that seem to be too much based on what I hear here, and it went the wrong way, but it never quite hit the stop loss, and then it came down and I took profit. So the challenging thing for me is, and I think this is why we cut our winners short and let the losers run, is because we don't get the exactly where does that stop loss need to be and how much time do you need to get it, because I've had lots of them that come back around and they fill. And I'm not talking about going 300 or 500 pips upside down. You know, I'm talking about going maybe 50 or 100 pips before it flips back around.
Yeah. So what you're talking about is stop loss placement and how to get those, and what's that balance between having them way too big, way too tight, and yeah.
And I think the struggle is also, you know, the larger your stop loss, the odds are more likely that you're going to fill your trade. So you want to have a high win rate, but at the same time, you can't let that run. So you're struggling to find that balance between where's the right place and when to cut it short.
Yeah. So what these two gentlemen in the front were saying, asking about stop loss placement, put it too tight, you get stopped out. When the market goes in your direction and you would have made money, you put it out way too far, and you have a tendency of getting those profitable trades more frequently, but then when you get the big one and it unravels all that. So how can we remedy that situation? Is the distance of your stop loss the only way to cut a loser short? What else? What is the other variable that goes into that? Your lot size. So, check it out. What if we increase that stop loss so we're not in that hot zone of constantly where the market comes down and just shoestring tackles you with a little wick and then goes right back up in your direction? Give that a little bit more of a buffer and specifically look for areas of strong support and resistance to work in your benefit to get behind for a stop loss. So maybe now you've got a bigger buffer in terms of pips. Your stop loss is bigger. But how do you neutralize that? How do you neutralize that so it's not a big hit? Your stop loss, or your lot size. Adjust your lot size, guys. Adjust your lot size so now you're not losing any more on that 50 pip stop as you were on that 20 pip stop. It's the same. You're keeping your risks small. I recommend 1% to my students. That way you can keep it small and limited. Okay. Little meme here, you guys. Can't let your winners run if you're always cutting them short. Huh? All right. So here's an outline. You guys should all have this. Maybe make some notes. I want to make some comments about this as well. But this is my outline. Okay, you want to know how I trade, my thought process in the market? This is it. Step number one, you should be going into your charts and analyzation by trying to identify where the strength in the market is. That's first. Why? Why is that important? Because we are in a $6 trillion market. We're in the deepest, most liquid market on the planet. You guys, people talk about the stock market. We're in the financial market space in Forex where governments, central banks, hedge funds, insurance companies, the biggest, baddest financial conglomerates and entities in the world, where do they play? In Forex. Okay. What causes price to go up in a market, you guys? And I'm talking very, very simple, like Econ 101. an abundance of buying compared to selling. Anytime you have an imbalance, okay, buyers to sellers, whenever that imbalance exists, price will be going up. And the greater that imbalance, the greater in number buyers are compared to sellers, the more aggressive price will go up. Okay, think about that, and then couple that with the understanding that Forex is a $6 trillion market. So $6 trillion of capital that's out there, and if price is going up, what is that telling you? A majority of that capital is on the buy side of the market if price is going up. That's some pretty significant understanding to take with you. Why do we want to understand this, where the strength is in the market? Because that's going to give you a tremendous edge on being on the right side of the market. You guys, you don't want to stand in front of a $6 trillion freight train and try to pick up pennies in front of the steamroller when it's on its way, right? And how many of us have done that before? Ooh, I can grab that trade. I can get it. It's right there. It's a little 5-pip trade. Choo-choo. Forex freight train coming on through, right? So typically, we're in a long-term trading scenario here, but so I'm dealing with a lot of the time 4-hour and daily time frames. And that's the direction I'm looking to qualify my trade direction. We want to leverage the power of trends. Why? Because a body in motion tends to stay in motion. And I put in there, your pressure is an excellent indicator out of the tools that we have that can simply and easily help us identify that strength. The fundamental question, I hope you guys write this down in your notes because I didn't add it to this, that you want to ask as you are analyzing the market strength is the market bullish or is the market bearish? That's what you're trying to really answer. And you're looking at the evidence of price movement, you're looking at the evidence of your pressure, and that's going to help you determine, is the market bullish or is it bearish? And if it's bullish, are we going to sell? Even if we get a double cross that says sell, are we going to sell? No. Are you going to buy? Only if the other conditions line up will you buy. But that qualifies the trade direction for you. Okay, now, market structure. What I mean by this is understanding your support and resistance. Every single currency pair that you are going to be viewing is like its own environment. And within that environment of, say, the Euro USD, price is going to be moving up and down and down and down and up and down and down and up and down. And with the untrained eye, if you're looking at it, it just looks like chaos. It looks no rhyme or reason, just random. But upon further review, when you look at it, there's actual structure involved. And it's important to understand that structure, especially from a big picture point of view, so that you can see the forest from the trees. You can see the lay of the land for the Euro USD. You can see the lay of the land for the dollar yen, so that you're not caught up in the weeds of the minutia of the small details that are going to blind you from seeing the big picture structure. So what I mean by structure is significant areas of support, of resistance, trend lines, channels, Fibonacci retracement levels that have confluence of other support and resistance levels. Okay? So you've got to do that. You got to do that homework, that prep work. And of course, if the market's bullish and we're inclined to be buying, where is it that we want to be buying at? Let's look at your notes. Buy at support. I find it interesting that a lot of the time as I'm working with students, when they have a bad trade, everybody has bad trades, but the frequency of times in analyzing these trades where they are buying at resistance or they're selling at support, and not just any support and resistance, really heavy, strong support and resistance levels. And the reason why is because they're not getting the big picture view first. So that would be another cardinal sin, buying at resistance, selling at support. So we want to do the opposite. All right, indicators. Certainly we have these really incredible indicators in our tool set that can help us with precision enter our trades. Good trading is about building a case for the trade you're going to take, building a sound, solid case of evidence. So we're stacking the evidence, we're building the probabilities in our favor, and here we are with our indicators, which are layers, another way of layering those odds in your favor. So once I know that the market's bullish and I want to buy, once I understand the market structure and I can see that price is at or near support, then I can use my majors and minors, my TNTs, which are great for this, for pinpointing your entries, giving you a better chance of lower drawdown, bigger yield. So I keep things simple. I'm a big advocate of simplicity. Keep it simple, sweetie. Classic double crosses, majors and minors. You guys learned that day one. Buy and sell chomps. Who in here knows of a buy chomp and a sell chomp on the TNTs, right? Oh, please tell me there's a lot more than you, right? That should be pretty well known. Gray dagger is another one that I really like to use. And then, of course, number 4, always limiting your risk, always having protection. This is what, Ed Sakota is telling us 3 times. You got to cut your loser short. Don't have hopium. Don't cross your fingers. Don't just close the computer and walk away because you can't stand to look at it anymore. Don't hold on to losing trades. Have a plan before you even enter the trade what you're going to do. Know what your maximum risk is on that trade before you take it. Okay, so if you're going to risk 2% and your stop loss 50 pips, well, calculate your lot size so you're not risking more than 2%. And that's how you're going to be keeping your losers short. Okay, stop stubbornly holding on to losing trades. It's human nature to do this stuff, you guys. Very human nature. That's why we got to, kind of excise it out of us. So don't stubbornly hold on to them. And of course, how do we turbocharge our profits? How do you really add a turbocharger to your trading machine? That's how you do it right there, number 5. Let your winners run. Let your winners run. Let your winners run. Run, 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 run. I repeat, let your winners run. Patience is what pays in the market. Warren Buffett famously has said, the market is nothing more than a device that transfers wealth from those who are impatient to those who are patient. Amen and hallelujah. 100%. All right, let's dive into the chart, shall we? Sound good? All right, so I'm going to show some examples of trades that I've been in recently. And what I want to do is dissect the reasons why I like these trades. So you're going to see how I like to build a case for a trade using that outline of tips that I just showed you, okay? We're going to tie them all in together.